Welcome to Cotality's Housing Market Update for November 2025. The pace of growth in Australian home values accelerated last month, with the 1.1% gain in October the fastest since June of 2023. Momentum has been building in the rate of housing value growth since the first rate cut in February, pushing the annual rate of growth to 6.1% nationally. Monthly gains have been broad-based, every capital city and rest of state regions recording a rise in values, ranging from a 1.9% surge in Perth to a 0.3% rise across Hobart. Across the combined capitals, the 1.1% gain seen in October equates to an increase of just over $10,000 in the median dwelling value over the month. Since February, capital city dwelling values are up 5.9%, or approximately $53,700. While there's a whole range of factors contributing to stronger housing conditions, ultimately the accelerating growth conditions are reflective of supply falling well short of demand. At the national level, Cotality's estimate of home sales is tracking 3.1% above the previous 5-year average, while advertised supply levels are 18% below average. Such tight advertised supply levels against above-average levels of demonstrated demand have skewed selling conditions towards vendors through spring. Although auction clearance rates have eased a little, they have held above the decade average in the high 60% to low 70% range since the start of spring. The step-up in growth rates coincides with the expanded 5% deposit guarantee scheme, which went live on October 1st. That's likely added to housing demand, especially around the middle to lower price points of the market. Indeed, it's the broad middle and lower quartile of the market where gains are strongest. Across the combined capitals, dwelling values are up 1.4% across the middle market, and they rose 1.2% across the lower quartile, while upper quartile values are up 0.7% through the month. The upper quartile of the market is showing the lowest rate of growth across almost every capital city. Stronger housing demand at the lower price points is likely a culmination of serviceability constraints eroding purchasing power, persistently higher than average levels of investment activity, and what's likely to be a pickup in first home buyers taking advantage of the expanded deposit guarantee. Regional markets also posted a solid increase in the monthly rate of growth, with the 1% rise the highest since March of 2022. Regional WA recorded the strongest rise, up 1.8%, followed by regional Queensland, up 1.1%, and regional New South Wales with a 1% lift. With vacancy rates holding around the record lows of 1.5% in October, rental growth is once again pushing higher. On a seasonally adjusted basis, Cotality's National Rental Index has risen by 0.5% per month over the past 3 months, the highest monthly growth in rent since May of 2024. Although rents are re-accelerating, housing values are rising faster, which has placed some renewed downwards pressure on gross rental yields. At 3.40%, the gross yield recorded across capital city dwellings has reduced to the lowest level since October of 2022. With Darwin leading the rate of value growth over the past 12 months, as well as demonstrating the highest gross yields, the total return at 23.1% over the past year is far higher than any other capital. Investment housing loans have more than doubled over the past financial year across the NT, helping to explain the very strong market conditions. Sydney dwelling values increased by 0.7% in October, bucking the broader trend where most capital cities saw an acceleration in the pace of value growth. Sydney saw the monthly gains ease from 0.8% over the preceding 2 months. The milder rate of growth may be a sign that affordability challenges are finally starting to curb demand in the market. Stronger growth was skewed towards the middle of the pricing spectrum, where values rose 1%, while lower quartile values are up 0.8% over the month, and upper quartile values increased by a smaller 0.3%. Sydney is still seeing a scarcity of listings, with advertised stock levels almost 12% lower than at the same time last year, and 2.7% below the 5-year average. There are a lot of moving parts influencing the housing market. On one hand, we have persistently low levels of advertised supply and above-average levels of housing demand supporting value growth. On the other hand, we suddenly have a renewed inflation challenge and the prospect of a shallower rate-cutting cycle. Banking sector economists are no longer forecasting another rate cut in 2025, and some economists are indicating the rate-cutting cycle could be over. Adding to this is severe affordability challenges and stubbornly low consumer sentiment, which could further dip on the back of cost of living pressures and easing labour market conditions. The imbalance between demand and supply is likely to persist for a while yet. The number of home sales is a proxy for housing demand, and the trend to date has been resilient in the face of downside pressures like stretched housing affordability, high cost of living, and an earlier drawdown on savings. At the same time, immediate supply, based on listing numbers, is tracking at record lows for this time of the year. Newly built supply also remains insufficient. Dwelling commencements were 9.5% below the decade average in June, and completions were 15.6% below the decade average. An ongoing rise in construction costs is set to keep any meaningful lift in new housing supply low as long as cost and margin pressures persist. The Q3 inflation shock is likely to have implications for housing markets, with a dimmer outlook for future rate cuts, along with the potential for renewed cost of living pressures, possibly leading to a prolonged period of pessimistic consumer attitudes. With interest rates potentially at or near the end of their cutting cycle, we aren't likely to see a material boost to borrowing capacity from here. Another downside risk could be seen in a tightening of investor credit policies. Credit aggregates from the RBA to September show housing credit for investors is rising at the fastest pace since June of 2015. A further acceleration in investment credit could see tighter lending policies introduced. Given that investors comprise an above-average 38% of mortgage demand, tighter credit conditions across this segment of the market would dent demand. As always, there's a lot to stay on top of. You can stay up to date with all the housing insights and commentary at the insight pages of the Cotality website.